Hi, welcome back to the channel. I'm so thrilled to be again joined by Mark Hogreff with the Sun Point Home Loans, and we're talking about credit scores. The whole purpose of this is to educate buyers on the loan process and how to position yourself best for long-term success in this real estate world, which is the best. It's a wise decision to buy real estate. It's a great long-term investment for you and your family, and that's how most of the wealthy people in the world got to where they are is within real estate because they're not, hear about land. They're not building any more land, right? So homes are what will grow in value long term, and that's what we want. Plus, we need a place to stay, right? And so, why rent? If you're renting, speak with a loan officer today to see if you're qualified to get a loan. So, Mark, welcome back.
Thanks for having me.
Today, we're talking credit scores. So, you know, I know we can all pull our credit scores offline and stuff, but so what differentiates what's a good credit score? What's a minimum credit score? What's a credit score that is will never get a loan? And I'm sure there's ways for people to improve their credit.
Yeah, great question. And to be honest with you, it's not as simple as, what is the minimum credit score to get a mortgage because it really depends. I would say within the industry, having a credit score of maybe 620 or higher is a favorable number because that's where mostly conventional financing minimum credit score requires. Okay. But there are options for other loan programs if your score is lower than that. FHA financing is usually more lenient on credit score. We can typically go down to about a 580 credit score with FHA financing. Actually, FHA has a guideline. If your credit score is below 580, it requires a mandatory 10% down. So, obviously, when it comes to credit, the higher the better. Everybody knows that. And, when it comes to getting a mortgage, not to sound insensitive, but you are a number, and that number is your credit score. It is very, very important. And the higher the score, the better the loan terms, the lower the interest rate that you're going to be provided to as well. And it will help you usually more likely to get approved if your credit score is higher. So simply answer your question, I would say 580 is where you want to be at the very minimum, 620 for most programs. But the higher the better. When you say 580, when I say that, that's below average credit. The national average for credit is about 660 to 680. So you're coming well below that. Okay. Um, you know, when a client comes to me and if they do have credit issues, first off, I hope they come to me as early as possible in the process because the more time we have, the better. I can coach them on their credit. I can give them advice on things to do. If somebody comes to me and they've already found a property and I'm pulling that credit is what it is. I mean, we're working with that. And if I can make it work, great. If I can't, unfortunately, I have to deny the client at that time. So, having time on your side starting early, if you do have credit issues, is uber important.
Yeah.
So, yeah,
Yeah, it's tough because I think it's interesting when you think about this. What's more valuable to somebody, good credit or money in the bank? You know what? It's credit because you might have some money in the bank and have lousy credit, and you can't rent a car, you can't get insurance, you can't get a loan. But if you have great credit, you're a better candidate to get a loan. And even though you don't have a lot of money in the bank. So, yeah, credit is key and start early. I know I told my nephews years ago because I learned from my lessons like, look at if you can try to stay out of debt or pay up, pay your credit cards monthly so there's no balance, not only because it's building great credit for you, but you're not paying the interest on. You're just throwing money away by doing that. So be wise. So
sure.
credit is very important. Um, we talked about VA loans in the last segment, and obviously VA loans are also based on credit as well, right? I mean, just because you're a veteran doesn't mean you're getting a loan. You also have to have decent credit.
For sure. 100%. Yeah. I mean, VA will also go down to even 500 credit score, but the higher the credit, the more likely it's going to go through. Okay. When we start getting to low credit scores on VA financing, It may or may not. It looks at collections. It looks at recent payment history. It looks at how they're paying sometimes their rent too as well on low
Mhm.
credit score situations. So yeah, having, average or above credit is very important when getting VA financing or any financing. One of the biggest things I see nowadays is, 'cause, like you said, everybody can get access to their credit scores. A lot of credit card companies will provide you with your credit score. You get Credit Karma. Other companies will offer it free. They want you to sign up for credit monitoring service. Have you sign up a subscription to that. What people don't realize is there's different credit scoring models depending on what type of credit you're applying for. So a mortgage company in the mortgage industry has a mortgage FICO. When you're getting access to those free credit reports, typically it's what the credit card companies use. So they're different scoring systems. And, you might think you know where your credit is, and then the mortgage company pulls it and it's 20, 30, 40 points difference. That's the reason, is because it's a different scoring system. So again, it goes back to my point. Talk to a mortgage company early on in the process, have them run your credit. Hopefully it's as good as you think it is. But if it's not, they can probably coach you. And that's definitely what we do to try to get those scores up as high as it possibly can. So when you're making that purchase, you're going to get the best terms possible. You're going to get the lowest interest rate and the lowest monthly payment. I would say also that most people don't realize what makes about a third of somebody's credit is having revolving credit cards. You have to have those because it builds strong credit. Sometimes I'll have clients come to me and it's like, well, I don't have any credit cards, but I pay my car on time and I don't have any bad debt. And then I pull their credit and their scores aren't that good.
Great.
It's because they don't have credit cards. Unfortunately, it's one of the most common forms of credit. So you do want to have those. You want to keep, obviously, like you said, your balance is low and not pay those high interest. But having some revolving debt is important. It shows the credit bureaus that you're actively paying on debt each month. So
Yeah. And I know that this might be a little bit off topic, but one of the things I always tell my buyers prior to closing, don't go and buy anything. Don't put anything on a credit card. Don't go to Rooms to Go or buy that car prior to
for
the
sure.
loan. Because are you guys pulling the credit again prior to closing?
Yeah, what you'll see with almost all mortgage companies is they do a credit refresh right before closing. And
Right.
what they're looking for is you didn't take on any new debt. So if you go out there and buy a car during the loan process, or sometimes somebody will come to us and they just made a major purchase and it's not showing up on their credit, those are things that are going to be factored in. So yeah, when you're going through the home buying process, you don't want to take on any new debt. You don't want to, make any major financial changes. No, don't quit your job. Those type of things. But when a lot of people buying a house, they want to, start buying things for that home, furnishings,
Right.
appliances, stuff like that. I always tell them, well, wait till you get the keys, then go ahead and make your purchases, and then we know that it's not going to impact the loan.
Right, especially those who are on on that the verge on like on the edge of that cliff of getting qualified to buy a home or not, because that one purchase can just throw off your ratios or lower the credit just enough for you to be denied that loan. And
Sure.
and for those who don't realize this, with the way that the contracts are written, if it's 30 days past the effective date of the contract, you really your money, your deposit is non-refundable. So even though you're not qualified to get that loan 30 days after, so keep that in mind too. Um, and you know why? That's why you should align yourself with great, mentors and teammates in real estate and loan officers too, because we're going to guide and help you through this process. So those important dates are not missed. That's so important. So, well, Mark, thank you for another great episode about, interest rates and what we've chatted about in the past. And for those who are tuning in, we've got numerous segments on the loan process and how to get a loan and the difference between conventional and FHA. So subscribe to the channel. Mark's information will always be in this channel with me. And we're here to help you make wise decisions regarding your real estate purchases and sales in the future. So, Mark, thank you again. And looking forward to seeing you on the
Thank you,
next
Howard.
episode, Mark. Thanks.
Thank you.
Have a great day, everybody.
Okay.